Good afternoon, everyone. Welcome to the next edition of Market Matters. Thanks for joining us today. Today is August 3rd, 2021. I think there's a lot of great info that we'll touch on today, very timely. By way of an agenda, we've got Hank McLarty, our CEO of Gratus Capital, that'll join us here in just a minute to share some thoughts about what we're doing at Gratus. I'll then move into some of the economic updates because there are quite a few moving pieces on that front right now. And then finally transitioning that into the investment outlook. So with that, I'm going to turn it over to Hank, and he's going to share a few thoughts of what we're doing at Gratus. Hank.
Thanks a lot, Todd. It's good to see those of you that I can see by Zoom. I guess that's the world we're in now. We are hoping to have in-person market updates like we used to prior to COVID in the late fall, but we'll have to wait and see how COVID and this Delta variant plays out, but certainly hoping that we can see everybody in group settings sometime in the not too distant future. And Todd's got some great talking points today on the market and economy and so forth. And I appreciate him giving me a few minutes here at the beginning just to give some general updates on how the firm is doing and just some general thoughts. So I'll start with, I'm really proud to let all of you know that for the 6th year in a row, we've been ranked by Forbes as one of the top 250 financial advisory firms in the United States. And just to break that down a little bit, I've done this for some of you in the past that have heard me, but there's over 400,000 firms and advisors out there for Forbes to choose from. And they go through a very strict process of looking at client turnover, compliance, records, investment performance. It's a very lengthy process that we go through to make it on this list. And so I continue to be extremely proud of our team and the way they're working and putting all the effort into taking care of our clients. So I wanted to make sure and let you know that we'll be sending some updates out to all of our clients and network in the next few weeks about the Forbes announcement. Secondly, I wanted to let you know that we're moving into our new office on October the 1st, and that's been a huge project for us. We've taken down an entire floor of one of the high rises in Buckhead, and we'll be making that announcement and sending out more details as we move into the new office. But October 1st, we will be in our new space, and we have spent so much time designing it and making it extremely client friendly with tons of new meeting rooms and spaces and the most up-to-date technology for Zoom meetings and conference rooms and so forth. So we're super excited about that, and more details will be coming, but we'll be in our new space October 1st. And then I wanted to just mention about our investment strategy group, which is the team that Todd leads. I just wanted to point out, they have done such an amazing job. Long term, they've done an amazing job, but especially in the last year and a half, 2 years, our performance has just been incredible, especially in light of the fact that we've been dealing with some crazy markets and information about COVID, and is the economy going to recover, and what types of stocks are going to do well and what aren't. Our alternative investments and the different asset classes that Todd and his team manage have just been stellar, and it's been really enjoyable to talk with clients about how their financial plans are coming together when you can always talk about the investments having performed so well. So hats off to Todd and his team. And then finally, I wanted to mention, this is the most important thing I wanted to mention because it relates to all of you, that just this year in 2021, we've hired 12 people on our team, and all of that is to ensure that the service and the responsiveness and professionalism that has always set us apart, that we exceed your expectations. That's always been a top priority for me, and it's a top priority for the firm. So essentially, we want our firm, as we continue to grow, that we can all grow together, both the firm and the client. So we've got to make sure that we're exceeding your expectations in our service and responsiveness. So we will continue to invest in the top talent and build our team to make sure that that's the kind of environment that we're taking care of you in. And with that being said, I'm going to turn it over to Todd for the most important information about the markets and the economy.
Great. Thanks, Hank. Appreciate that. So as I mentioned in the agenda, we're going to go over some economic updates, and then we'll transition over to the investment outlook. And, starting in August, we're looking back now at what's happened in July, because now we finally got the data in. And I think there's a subtle shift starting to occur in the markets that we're starting to pick up on. And what you're seeing in front of you is a picture of both the manufacturing economy on the left-hand side and the service economy on the right-hand side. Just by way of reference, any number above 50 indicates the economy is expanding in those sectors. Any number below 50 means the economy is contracting in those sectors. And what you can see here is a couple of things. One is the manufacturing sector is continuing to just plow forward, which is great because that means that we're creating new jobs, potentially insourcing some of the supply chains back to the US. But on the services side, we have noticed a little bit of a trailing off in at least the strength of the growth. And that's just, I think, something to keep note of, because it could mean that the peak growth, as I'm calling it, may be now in the rearview mirror. And that actually does have some implications to it. And we'll cover on what those might mean in the future. But I think this is just an important understanding to keep in mind, is that the best growth from the recovery from COVID may be in the rearview mirror. And that this, of course, doesn't include anything that might happen around the forthcoming stimulus plan. But I think there's, something to be said for this slowing that's occurring right now. By the way, if you do have any questions I forgot to mention, please log those into the chat feature and I'll grab those and try to address those as they come in. Here's a look at what's actual aggregate growth in the economy. It's called the gross domestic product. It's just a measure of growth in any economy around the world measured in dollars. And what you can see here is Goldman Sachs's estimate here of 9, 5.5, all the way down through 2022. And you can see what's actually occurred in Q1 and Q2 so far. And then the consensus number, which is an aggregate of all the research houses and what they might think might happen. So a little bit lower for the aggregate. But I think what's important to note here is that in Q2, what Goldman and others were predicting was a number of growth in the US economy of close to 10%. What we got was 6.5. And so there's a big delta in there that is really important to try to understand why that might be the case. So I think this is just confirming what I mentioned in a previous slide, in that some of the best growth numbers might be behind us here, and we have to make some preparations for that. But still, 6.5% is nothing to sneeze at on an annualized basis. Much higher than trend levels of 2% coming into 2020. So, an aggregate is still a good thing. The million-dollar question, as we keep going back to it, I think in a number of different ways, whether it's in equities or in bonds or in private markets, is inflation holds the key to almost every asset class right now, because that has a way of influencing the bond market. And I think there's a boogeyman out there in the media potentially that suggests that, because we're really currently now in a 4.5% range on what they call the consumer price index, that's one way to measure inflation, that this is going to exist in perpetuity. And I think, the Fed and others have indicated that this is what's called a transitory inflation reading, meaning that it's going to move back lower over time. And I think, as much as I likely don't want to admit that, that's probably the camp that we would fall into as well, primarily because, as you can see here, roughly 73%, 72% of the time, inflation has been averaged below 4% since 1928. So the numbers are certainly in our favor to suggest that, from here, after popping up into between a 4 and a 5% reading, that we would likely migrate lower into this lower range, probably similar to what we started off, 2020 with, and that was an inflation number between 1 and 2%. And again, why would we think that? Well, the big reasons are it's the 3D hurricane, as Rob Arnott from Research Affiliates likes to call it. It's a combination of debt accumulation, demographics, which is combined very deflationary. So more debt does not mean higher growth in the future. If anything, because it pulls growth forward into the present, it's deflationary over the long term. And so in that way, we think that likely inflation will start to taper off probably in the back end of this year into 22 for sure. And that's something, one of our central tendency, if you will. COVID is something we do have to unfortunately pay attention to again, because it does appear that the Delta variant, as I'll show you on the next slide here, is much more virulent than the COVID Alpha version. And this just is meant to show you the progression of cases in the US indexed to a common starting point. I think it's like 60,000 or so, and kind of how that evolved over the preceding 6 months or so. And if the UK, I would say one upside to, or not upside, but one silver lining to this dark cloud, of course, is that other countries have already been dealing with the Delta variant in a major way. England, or I'm sorry, the United Kingdom being the most recent example. And actually, because of herd immunity issue, situation, as well as their vaccination to this point, which is exactly almost the same as the U.S., it does appear that they peaked in their case counts far earlier than this chart would suggest. So, but if we're using this chart, then we would reasonably expect some time between mid-September and October before case counts start to peak. If we use the European progression of the Delta variant as a model, then maybe it's actually early part of September when case counts would be peaking, which would be good. And this is why the Delta variant is so much more difficult, I think, to deal with. It's because of this, what they call R0 or R0. And it basically measures, I do not want to hold myself out there as an epidemiologist by any means, but this is just a measure of this R0 reading is a measure of virility, or how easily it is to spread. An R0 number, just for reference, of, let's just call it 2 for the common cold, would mean that in 2 weeks' time, the virus or the common cold would spread to 2 to 3 times as many people as what currently have it, if that makes sense. The COVID Alpha variant, why that was such a problem was because you can see it as it relates to other outbreaks, was that you had an R0 reading of 4 to 5. And that would say that in 2 weeks' time, 4 to 5 times as many people would have COVID-19 as current day. And what is the Delta variant suggesting? Much more virulent. It's a 5 to 8 times as many people would have caught the Delta variant than 2 weeks from now. So this is one reason why we have to be a little cautious in looking at how to deal with this. But I think the good news is that most municipalities, governments have realized that shutting down completely is not really an option. Therefore, the economic impact may be much less so this time around than it was in March of last year, which I think is a good news, at least from an investor standpoint. So let's take a look at the investment outlook, because the economic outlook still remains pretty supportive. COVID-19 Delta variant doesn't appear to be as impactful as maybe it once was, as the Alpha variant. And so this is how we're approaching the current opportunity set. And this may look pretty similar to prior periods, but we did make one change. I think there is and the most recent change to talk about, which is, I've noted a slide later in the program, is what's going on with China and how that's affecting our rating for emerging market companies at the moment. But you can see we've broadly downgraded bond portfolios, or bonds in general, in favor of liquid alternatives or private market alternatives to be seeking our income needs. We're still relatively neutral, mainly on large cap US and developed market international stocks. Mid cap, we still have a open slot there, which is going to be filled likely here shortly. But we still have a fairly neutral reading on stocks at the moment. And here's just some notes about that rating scheme. So coming into August, I think we should all be expecting a little bit higher volatility level. I'll show you why we think that's to be the case. And interest rate fluctuations are driving a lot of that volatility. Increasing our portfolio liquidity right now is a priority, and we've started some of that effort already with some tactical rebalancing. As I mentioned, 4,400 was our level to start that process, and we've already started to process some of those trades to start trimming back equity positions primarily and adding to a cash placeholder position, not in a substantial amount, but in a modest amount. We are maintaining our equity positions in the U.S. or on the equity side, because valuations in stocks do make sense in the context of a strong earnings tailwind. I would say just briefly, the Chinese crackdown is something very troubling and something that would be not necessarily an investable opportunity set at the moment. But if prices get low enough, then I think we have to reconsider that as an opportunity. And then finally, I would say internals remain supportive, meaning some of the technical readings, they're not quite flashing those warning signs yet. Fixed income, it's still steady as she goes. We prefer shorter duration, higher quality fixed income, and that's to maintain that capital preservation objective of the fixed income portfolio. Inflation still a big question mark, but we do see a migration, downwards over the intermediate term. And then, as I mentioned, we still are not avoiding or not chasing some of the yield or economically sensitive categories that tend to have higher yields attached to them. Those things like high yield preferred stock. I just can't understand why people still find these attractive, because they're being issued with all-time low yields, and that just makes them very unattractive. So let's take a look at where stocks are right now. This is the beginning since the end of Q2. So this is the first look at Q3 that I think we'll be touching on. And you can see, as has been the case for prior periods, the S&P continues to lead most global stock markets higher. And this is being led primarily by large cap technology companies, but also some other areas of the market. Healthcare has really come to life, which is, I think, something that we're really positive on. Also, materials are very positive at the moment. So we understand what's going on here. International large cap companies continue to be positive, but what's not positive would be I would say, areas that we've avoided to this point and for the better part of the last 10 years in large part, and that is we have zero small cap exposure. So far, those have not been additive or would not have been additive to a portfolio. In emerging markets, there's reasons to avoid emerging markets, and I think some of those reasons are manifesting themselves as we speak. So we're very comfortable and happy with our positions up here in the black and red lines. This is what I was mentioning about the stock market action, price activity actually makes some sense. It's because earnings estimates in the S&P continue to go up. I showed last quarter how in Q2, those earnings estimates continued to trend higher over the course of Q2, which led to a very positive quarter for stocks. And that started again here in Q3. So since the beginning of Q3, earnings estimates have risen in the S&P for this quarter from $47.50 a share up to over 49.25. So in that way, we're getting price movements being directed by earnings growth and not by multiple expansion, which of course is, I think, a really bad way to get growth in any asset class, because it's just momentum essentially. And this is what's interesting about this earnings growth is that it's coming, and companies are not necessarily having to discount their products, meaning that they're able to maintain margins, which is a really interesting dichotomy here that some might not think is very obvious. One thing I did want to point out, because I did get a number of questions about this, is aren't the valuations in stocks, continuing to make you a little cautious or concerning? I would say certainly based on historical averages, those can be a little more troubling. But then again, I would also suggest that we might need to start modifying or looking at the go forward or steady state rate of price earnings multiple that we need to be considering for the average for stocks. So what you can see here on the screen, this is the cyclically adjusted PE ratio, CAPE ratio. It just takes the average of the last 10 years PE and averages it together. And I think the only point I wanted to make with this chart right here is that over time, for one reason or another, it does appear that the equity asset class has been trading at higher and higher multiples on average over time. So to me, that just suggests that equities as an asset class or an asset category are moving into this higher level, potentially, of valuation that actually makes a lot of sense when you compare it to the low rate of bonds. But also, this isn't a recent phenomenon. It's been going on since really the 1950s into the 80s, and then into the mid 90s. So I think this higher normal steady state of PE multiple might be something that will be with us for some time. And again, it's all about opportunity costs. I think a big part of that has to do with the fact that bonds are trading at very unattractive valuations. And this is what I wanted to just point out in relation to volatility. This is a look at the VIX index, or the volatility index. and it just basically measures the amount of option buying on the S&P. And when this line goes up, it means a lot of people are buying options on the S&P, or put options, which is protection. And that means they're fearful, essentially. They're trying to protect their downside risk. But if the line's going down, that means there's risk taking going on, and people aren't as concerned about downside risk. But I just wanted to point this out because it does appear that starting in the first part of Q3, we've entered this upward trending volatility regime, or VIX index regime, which to me suggests that we might have a little bit of a bumpy August in front of us, and in that way, having cash available to be ready to pounce on opportunities when they come will be really important, and so just part of our process. It's not to say that we wouldn't be invested in stocks right now, particularly if it was a new client, but it just suggests to me that we have potentially some better opportunities coming in front of us. And then finally, another reason why I don't get terribly excited about where the stock market is at the moment, it's because a lot of the sentiment indicators have really gone into or collapsed, I think, from euphoria back at the end of 2020, now into this almost bearish outlook. So this is what you're seeing here is a CNN Fear Greed Index. You could look it up on the CNN website if you wanted to. And it's got a pretty reliable record of when we get to these extreme readings of, really over 80 or below 20, that those tend to be good contrarian indicators, meaning that if this index is above 80, it means that a lot of people are feeling really good about the markets, and it's probably a good time to start raising some cash or being a little less aggressive. Interestingly, this was very high right before COVID, and that just might be coincidence. But right now, look at what's happening. We're actually trending down towards this very bearish level of the stock market. And markets don't go down if everybody is already bearish or thinking the markets are going to go down. And therefore, there may be some additional upside potentially ahead of us, just with more volatility along the way. And then let's turn to the big thing I think that's changed recently that I wanted to bring everyone up to speed on, and that is what's going on with the Chinese market. And it might seem a little silly to focus on China and Chinese markets, but we are not isolated in the U.S. It's a global interconnected economy, interconnected capital markets. And as COVID laid bare, we all have supply chain connections and consumers for internationally oriented companies interconnected. So what you're seeing on the chart right now is a 12-month look back at a price movement of the S&P in black and the Chinese large cap stock index. It's the FXI. I think it's the largest 50 companies in China. And you can see what's happened here is that starting in about mid-February, that index just has been on a one-way train lower over time after being pretty consistent with the US markets. And what's happened here is that the Chinese government has really cracked down on a few sectors in the economy to try to really rein in their exposure to foreign capital, is my belief. And so that first they went after some of the tech giants, where they prohibited Alibaba from IPOing their financial arm called Ant Financial. And they really re-regulated that and attacked companies like Tencent for a variety of other reasons, which are their national champions, by the way. Chinese investors lost money as well too. But more recently, they've also been attacking or regulating very harshly the for-profit learning companies, where tutors in China are educating not only domestic youth in China but also internationally. And really, it's to try to reorient the messaging or the learning that's going on within China. In that sector, the for-profit sector, which has been converted by force to non-for-profit, is down 95% over this time frame. Didi Chong is a ride-sharing service also that had some harsh regulations attached to it after it went public just a few weeks ago. And so I guess my point is that China is actively changing the rules of the game. And within that context, it makes it an unbestable market for us. So those of you that know, we have very little exposure to China and emerging markets in general. I think on average, we've got maybe a 5% weighting in our equity sleeve, which is really just a toehold weighting. We'll get more aggressive if we get a more substantial sell-off to add to that. But for right now, we think that our weighting makes a lot of sense given what's going on in China. So turning to fixed income, really a snapback that occurred starting in Q2 and it's extended into Q3. And you can see this is just a small window in time in Q3, but we've also seen a pretty substantial upturn in performance in the bond market. And what's driving upturn in performance? Well, I mean, it's essentially bond yields have been going lower in the U.S., which has been driving prices up. And you can see here the blue investment grade index is up almost 2%. High quality bond index is our aggregate bond index is up 1.5% so far in Q3. Emerging market bonds are up 80 basis points. We have no exposure here. These are still negative for the year. And, go figure junk bonds, which are trading at very, very rich yields, haven't really found many buyers since the start of Q3. And I would really be surprised if they would have any substantially better performance from here, given where they're starting. But this is just kind of the lay of the land in the bond world right now. And this is exactly what I was talking about was, this is the 10-year bond on the screen in front of you. It's a year look back. So from August of last year to August of this year. August of last year, bond yields were trading at 55 basis points, all the way up to 175-ish or so in mid-March, which created a lot of price pressure on bonds through this whole time frame. But what happened starting in April was that bonds actually have done pretty well because their yields have been gone down and prices have gone up. And I think what the bond market is telling us here is that it's started to sniff out this deceleration in growth in the economy that is just starting to show up now in some of the numbers. And therefore, if growth is going to be lower than expected, then inflation by extension should be lower than expected, which would mean that bond yields should trade lower than maybe the expectation. And that is our base case. And I would also suggest this wasn't something that we weren't thinking about as well either, because when I last showed this chart, this is a chart that shows you the correlation between the stock market and the long treasury bond, the TLT. And if there is a positive relationship, meaning above zero, that means stocks and bonds are going up or down at the same time. If there's a negative correlation, that means that stocks are going up potentially at the same time bonds are going down, and then vice versa. If stocks are going down, bonds are going up. And that has been a historical relationship. As you can see, the average is a very negative established correlation, stocks versus bonds. And our thought here maybe a few months ago was, well, once we kind of reach this tipping point, that it might turn lower to revert back to this more steady state, more of a mean reversion. And I think this is one of those things over time that we can feel pretty good about, unless some of the circumstances change. So that's kind of our base case as well, is that part of the reason bonds are moving lower is because it has to do with demand from a slowing economy, and also some of this relationship that tends to be pretty sticky in bonds versus stocks over time. So here are just a few takeaways. I think I'm just right on the 2:30 mark, which is great. This is probably the first time ever I've been right on time. We still favor stocks versus bonds, generally speaking. So that's why we had coming into the beginning of the year, maybe a higher than more normal allocation to stocks versus bonds. And we made some of those decisions and changes throughout the course of Q1. I would recommend you take a look at our capital market forecast as well, because we did publish our forward-looking returns for the first time ever to help inform this decision right here. We do have a preference of alternative strategies that are income generating over bonds. And by and large, these strategies have been working as designed, which we're really happy about. So I think we saw some of this pricing pressure as a possibility within the bond market. We started to allocate a little bit heavier towards alternatives, and that I think ended up being a pretty good decision. One thing to note here, we are preparing for higher levels of volatility. That little correction we had, I believe it was earlier in July, really didn't even touch the 5% point. So we still would be on the lookout for 5 to 10% correction from here. It'd be totally normal, and a strong up move for stocks. And we are looking for opportunities to deploy capital when that volatility does show up. And again, incrementally raising cash via short-term ETF. That continues to be our implementation plan. And it's going to be a really important part of earning above market returns, I think, in the future, when you can implement this type of disciplined or programmatic rebalancing strategy. So I'm going to pause it there and just see if there are any questions that anyone might have from the audience. And again, if you have any questions, please feel free to lob those into the chat feature, and I will grab those off as they come in and see if I can answer them. While we're waiting, I did actually have a slide to show you here in the appendix while we're waiting. And this is, again, not going to take too long to recover or to move back to while we're waiting. But one of the foundational concepts I think that I like to touch on is risk versus return. And what you're seeing here on the screen is a plot of yield on the left-hand side versus correlation to the stock market. Things that have high correlation to the stock market, like high yield bonds that do have higher yields, are what lots of folks would consider to be income generators. But you also have to recognize you're taking on equity risk or stock market risk, and those are likely to get hit when the stock market comes down. Versus as the volatility dampeners, this is that foundational concept I just want to kind of hammer home here, is that all these categories down here, which really do now make up the core of our fixed income portfolios right now, these are government bonds, municipal bonds, treasuries, mortgage-backed securities, cash, asset-backed, have very little to almost no correlation to stock market. And these will serve as our volatility dampeners when the markets get choppy. So anyway, I thought this was a really great slide to kind of hammer that point home. So I do want to thank you for tuning in. I'm much appreciated for your time today. We did record this. If you did want to listen to it again, that'll be posted to our website. And I look forward to talking to you all again next month. Thanks, everybody.